Chairman Powell was very clear that he is not backing down from his position that the economy needs support. The statement of the Federal Reserve Open Market Committee was not changed. No change in policy with respect to interest rates. Most importantly, the first lever that they might be expected to touch was the Fed's asset purchase program, which the chairman said would continue at its previous rate. So he's made very clear that it's steady as you go for the Federal Reserve, and that was what markets really wanted to hear at this point, a continuation of that supporting policy.
So then talk about the Fed's read on the economic recovery. Any warnings about possible hurdles?
The members of the Federal Reserve present their own individual forecasts, which are agglomerated into this thing that we call the dot plot. It is clear that if you look across all the membership of the Federal Reserve, you do see faster projections of growth than were anticipated the last time, which was December. And as a result of that, the projections of when interest rates will begin to have to rise is edging a little bit closer to the present. You're beginning to see a couple of members of the Federal Reserve Open Market Committee saying that they think that there may be interest rate increases in 2022, even though the body of the bulk of the group we're talking about later than that. So it does look as though there is a sense that growth is accelerating as a result of that. We will begin to see somewhat greater pressures on interest rates, and you have to ask the question, when is that going to reach the point that the Federal Reserve is going to have to start talking more seriously about higher interest rates?
And speaking of concerns, talk about the inflation concerns that have been raised and how the Fed is really viewing them.
The Fed believes that the economy is very stable with respect to prices. They really don't see a tendency or a bias towards faster inflation. The forecast for this year is predicated upon additional consumption as a result of the stimulus legislation that the Congress just passed, and the anticipation is that increase in inflation will prove to be temporary, and the rate of inflation will slow next year. So there's a sense that we have an extremely competitive economy. We have an extremely competitive global economy for that part. There really isn't that much power on the part of sellers to be able to raise prices. And as a result of that, it's not likely that we are going to see faster inflation anytime in the near future.
And obviously with the mammoth package for the stimulus aid package, we're looking at U.S. federal debt. Just how fast is it rising, and what should we be keeping an eye on?
We need to understand that we had a debt problem before the pandemic. And then with the onset of the pandemic, we had an enormous amount of additional spending and tax reductions passed to try to keep the economy moving without any movement at all towards trying to offset that cost. So we're now at the stage where within a 10-year time frame, realistically speaking, the United States will almost certainly have the highest debt burden described as a percentage of our gross domestic product, the highest debt burden in its history, even higher than it was at the end of World War II.
So
the time will have to come when we're going to have to address that.
So then just very quickly, we have about 20 seconds. As every country faces that challenge of balancing spending with growth amid the pandemic, what are your predictions for some of these other global central banks this week?
I expect that we will continue to see support for the economies. There is still concern about the state of the pandemic. But policymakers are going to have to start thinking about how we get our interest rates and our budgets back toward normal.
Indeed.